Brad Williams, Frugal Finance. Selling income properties. If you elect to use this particular model, keep in mind it's dated and it's what I call a naive model. Very simple. Today, you're going to use a little more complexity, but if you elect to use this, just be cognizant that there's other methodologies. I'm going to keep this as simple as possible. An investor buys into real estate with certain expectations about its performance over a set period. These expectations shape the investor's calculations of how the investments will fare. However, once the property is acquired, various factors can shift its actual performance, prompting the investor to reassess whether it aligns with their objectives. Market conditions might not evolve as anticipated, affecting rental income, or tax laws could change, altering the investment benefits. Regular evaluations are crucial to decide whether to hold on or sell property. Even if the initial projections hold true, there are still reasons why an investor might choose to sell after a number of years. One significant factor involves leveraging benefits, as discussed in other sections. With a mortgage featuring positive amortization, the loan balance decreases annually, boosting the investor's equity. While this may seem advantageous since it means more cash on sale, it also means more capital tied up in the property each year. An increase in the property's value adds to the equity buildup. This buildup represents funds that could be redirected to other investments in the property if the property were sold. Essentially, it's the opportunity cost of not selling. The proceeds from a sale reflect the equity invested to maintain ownership for longer. However, unless the property is refinanced, a larger portion of equity remains tied up relative to the income generated. Additionally, while the total mortgage payment remains constant, the interest portion decreases annually, resulting in reduced tax deductions. Consequently, the investor gradually loses the benefit of financial leverage over time. A decision rule for property disposition. Investors often grapple with the decision of whether to hold on to a property or put it up for sale. This decision-making process hinges on an evaluation of various factors, guided by what's known as incremental or marginal return criteria. To illustrate how this criteria comes into play, let's consider a hypothetical scenario. Investor bought a small retail property 5 years ago for $200,000. At the time of purchase, the box center, as it is called, was already 15 years old. The purchase was financed through a 75% mortgage at 11% over 25 years. For tax purposes, depreciation is calculated using a straight line method, with 80% of the original cost allocated to the building and 20% to the land. It's worth noting that the property was acquired prior to this tax reform. Why don't we say the 2022 tax reform? Because seemingly there's one every year these days, which means that the straight line depreciation is spread over a appreciable life of 31 years. Additionally, the investor faces a marginal tax rate of 25%, which has the maximum rate in effect for 2018 to 2022. And that's not accurate because the changes are ongoing, and I don't know what the most recent changes are. Just go along with it. It's a hypothetical. To understand the performance of the property over the past 5 years, we can refer to this pro forma. You should be able to read this. We just have before tax cash flows, our rents, less operating expenses, net operating income, before tax cash flow, 1858. Net operating income, less interest, depreciation, taxable income or loss. We're taking advantage of this tax, and we're carrying a negative net income. Then after tax cash flow, before tax cash flow, less taxes. If the box property were to be sold today, estimates suggest it could fetch around $250,000 on the market. However, it's essential to consider the associated selling costs, which amount to 6% of the sale price. The projected cash flows from the sale of the property, if it was sold today, are detailed here. It's important to note that any capital gains resulting from the sale would be taxed at ordinary income in accordance with the current tax act. This assumption is based on the understanding that the property would be sold after. Now, keep in mind, there are exchanges out there where you can sell this, roll it over to a similar type property and defer the tax situation. These assumptions are laid out for two primary reasons. First, they reflect the common scenario faced by investors at the present time. Secondly, they serve to highlight the implications of purchasing a property under one set of tax laws and subsequently deciding to sell it under a different regime. So here's just some numbers. We're going to have this capital gains. I think this F70 should be this 250 minus 200. In my opinion, your capital gains is the 50 grand above your original principal. I'm not going to mince this. Using this information in table 14.2, we can calculate the rate of return the investor will gain for the past 5 years if the property is sold today. Here we have this before tax cash flow, our sales price net. This is 70, and I guess I probably could change this, F9. This is going to be 70 plus the 5th year cash flow. Before tax cash flow, 18.26 return. After tax cash flow, 1626. Looking at the numbers, if the property were to be sold today, the investor would see a before tax return of 18.26% with an after tax return of 16.26%. But does this alone offer a clear-cut decision on whether to sell? Consider this scenario. The investor initially anticipated an after tax return of 16%, yet the actual return would only be 16.26% if the property were sold. Does this mean selling is the right move? It's not so straightforward. The property's performance, 16% versus 16.2%. Do you draw the line? Are you hardcore at 16%? However, this doesn't mean it's a poor investment going forward. If we assume that the historical returns reflect future performance, then it's likely that this would be factored into the current selling price of the property. Potential buyers typically base their offers on expectation of future performance. However, important to note that historical returns don't always predict future performance accurately. Brad Williams, Frugal Finance. Thanks for watching.